Hello and welcome to All Things Money. I'm your host, David Blain, and welcome back to the second segment of the show. If you missed the first segment, we were talking about Marty Zweig, who died back in February, and he was known as the man who called the crash back in 1987. But as Mark Holbert of the Holbert Financial Digest tracked the performance of his actual fund investing people's money, with the exception of that one call, he underperformed the buy and hold of the S&P 500 significantly over the life of the fund. And to equal the performance of the fund, you only had to invest in about 30% market, 70% bonds, and you would have equaled the return of his all-stock fund with much less volatility. Now, a lot of market timers profess that their signals are not designed to outperform a buy and hold 100% equity strategy, but their goal is to just avoid major bear market losses. And, we at our firm have done this, in the past and come to realize that, yeah, you can do that, but you're not going to outperform the buy and hold. It's very difficult to make those calls, especially today, back in the 50s, 60s, 70s, before information was so instantaneous. There may have been some credence to that, but especially since 2008, with people hyper vigilant over the volatility of the markets and so much data flow, that reducing those bear market declines is a much more simple way of doing that. Just hold a more conservative portfolio at all times. Now, as I said last segment, high quality bonds have been having some issues the past couple of months, where we have a white paper coming out addressing that. But the reality is, in times of rising interest rates, historically, bond investors were able to obtain a return on their capital. Now, not a huge amount, and after inflation, an even lower amount. But the bonds are in the portfolio to buffer those declines in the stock market. So, Marty Zweig, I actually enjoyed reading some of his books and listening to him. He was a very thoughtful person, and nobody worked as hard as Marty Zweig. But it just goes to show you that just because you're extremely intelligent, you work hard, and you study the data, does not necessarily mean that you're going to outperform the market. Another person that is a little bit more, maybe you never heard of Marty Zweig, he got famous back in 1987. Well, there's another lady called Meredith Whitney, and she became famous back in 2007, warning that Citigroup would come under pressure and possibly collapse. And of course, that was sort of the beginning of the whole financial crisis. And using that newfound fame, she opened up a company called Meredith Whitney Advisory Group, and she went out on her own selling advice to firms. And this article that appeared in the Journal the other day was talking about how her firm, she hasn't really done anything since that market call. A couple of other things that she said. She was also the one that back in 2007, she was actually working for Oppenheimer Company, and she issued a research report on Citigroup, essentially saying sell the company. And then, of course, days later, the CEO, Charles Prince, resigned. The company cut a dividend, et cetera, et cetera. And in 2010, so she became famous by sort of predicting the financial collapse. So then she went on her own, and she made some other predictions. In 2010, she started talking about how, I don't know if you remember this or not, but how all these municipalities were in all sorts of financial trouble, and we were going to see a wave of defaults on cities and states. She went on, I think it was 60 Minutes. She went on the show saying that all these cities and municipalities were going to be going out of business, and certainly some of them did, quite a few in California. Of course, Detroit's having problems, but there wasn't this massive wave of defaults. And so we see there's another guru that made one, lucky call about Citigroup and tried to spin it into her own firm. Well, the article was saying that, that the majority of the clients that were paying her outlandish fees for her research, the majority of them have gone by the wayside, and that she only has like one employee left. But the point is not to besmirch Miss Whitney, but the point is that when you look at these gurus out here that make these one-time calls, or sometimes two. I mean, there was the Elliott Wave folks back in the 70s and 80s. There was there's been several other people that have made these market calls to get in, get out at the right time, and they've continued to live on that fame for a number of years. But when you actually examine the data, you see they really don't add much value. I was talking to someone the other day about Jim Cramer, who's on CNBC, the Cramer Show, and they were talking about how I read an article about how everything on that show is designed to get people's blood going and designed to make them trade. The colors on there, the noises, the lights, things like that. It's designed to get people to trade, and there are people with a lot more time on their hands than I have that actually track, you know, when he says buy, 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 or sell, sell, sell. There are people that write that down and track it. So there's databases, and you can see that only about, I think the last time I looked, about 46, maybe 47% of his predictions have turned out to be true. Once again, not actually worse than you would expect from a random stock picking. Now, from an entertainment value, you know, if you want to watch it, that's fine. He has some interesting things to say every once in a while, but to take his information and to go build a portfolio based upon it is just not a winning strategy at all. So hopefully that helps a little bit. We'd encourage you not to give too much credence to a lot of these so-called market gurus. Well, that's all the time we have for the second segment. When we come back, we'll pick up with some other topics.